welcome to GHAIN. Today actually was supposed to be our GHAIN event with none other than Mr. Mark Baltazar here. And we would typically be having this at the St. Nicholas Banquet Hall and we'd all be networking together. But due to times, we are making the best of it, aren't we, Mark?
Yeah, we're, I think Zoom stock price is up, and any digital, well, actually probably a lot of digital platforms. So it's the new way to communicate.
Yeah, it's going to change business as we know it. So first of all, thank you so much for sticking to this and obviously providing some value to the GHAIN community, because that's what we're all about. We want to share, educate, and I know that's a big part of who you are. So for those of you guys who don't know, I'd like to do a quick introduction here to Mark. So with 18 years of experience in business building and corporate consulting on the global stage, Mark brings a wealth of knowledge, business management and operational expertise in real estate investing. So he's been a winner of the Real Estate Investment Network's Top Player Award in 2017. Mark's continuing to build strong momentum in growing his real estate portfolio. So his strong analytical background enables him to bring a strategic rigor to portfolio expansion and the assessment of investment opportunities. With 5 years of real estate investing experience across various stages, Mark oversees peak capital raising, client acquisition, partner relations, educational content development, while ensuring the company delivers on its promise of helping others build generational wealth through apartment building investing, which is so awesome. This is why I want you in here. So in addition to helping others build their real estate portfolio, Mark's family life fuels his why. He's a husband and a father of 3 very active young boys. Very, very cool. And so just very quickly, I know you've got a company called Peak Multifamily Investments. Mark also, if you guys want to check it out, has an awesome podcast called the Canadian Multifamily Investing Podcast, which you host with Mike Rockwell, right? And I heard rumblings of a new book coming out.
Yeah, so I've been, it's a work in progress, so probably halfway through. Not sure what the title is yet, but basically it's kind of the 10 steps to getting started in apartment building investing. And it's I think what, Mike and I, we get a lot of questions from people trying to, get started in apartment building. And so, it's consistently the same questions over and over again, which is fine. Like, we had the same questions when we started as well.
For sure.
And so, the thought was, so I started writing. I started kind of writing down, a bunch of these points and really answers to the questions, almost like a frequently asked questions book, but in book format. And so there's 10 steps. There's really probably 11 or 12 steps, but we'll shrink it into 10. And and it kind of goes, starting from the main thing really is nothing to do with real estate at all. Actually, is your why, right? So why, what are you trying to achieve? What are your objectives? What are your financial objectives? Can real estate help in any way? And specifically, can apartment buildings help in any way? Because it may not, right? And so you want to kind of know that right at the outset before going down the path and then realizing like, oh, you know what? There's probably a better strategy to help me achieve my goals and objectives. So kind of step 1 is figuring out your objectives, your why are you doing what you're doing, or why do you want to embark on this journey that is apartment building investing? And then from there, you want to be passive, you want to be active, and then some of the things that we go through on a daily basis to acquire buildings. That's what it's about. So it's kind of a how-to guide, really.
No, I love it, and I'm actually glad you're touching on the big why, because it's funny. A lot of different real estate investing books have done that in the past, and they start off the book by thinking, okay, really reflect. And it's because it's so important. And even in your introduction, I'm so glad you incorporated a why and why you are doing this in the first place. Because, this business, as I'm sure you know, has its trials and tribulations. And if you don't have a strong why to lean back on, then it's really hard sometimes, right?
Yeah, no, absolutely. I mean, if as speaking to someone today, if you're not having tough conversations every day or making tough decisions, and you're probably not doing it right or not pushing yourself enough. I had the same conversation with my son yesterday, in terms of, if you're not pushing yourself or things seem easy, then it's time to level up or try something new or experiment. So yeah, no, absolutely.
New ceiling, for sure.
Yeah.
Okay, so jumping into the first question here. First and foremost, what are you doing throughout all this pandemic here?
So I think I wouldn't say business as usual. I mean, I think there's like this extra layer now that I'm sure a lot of people are going through it. I'm going through it, which is trying to keep a pulse more so than ever before, just on media, social media to some extent. At the outset, it was almost like it was, not even, I mean, daily for sure. In the morning, wake up, what's going on in the news, what's going on social media, and it took a little bit of a toll. It's too draining.
Yeah.
People were changing by the minute. In the morning, there'd be like, okay, we're gonna cope with, these changes, and then the afternoon was totally different, and so it got a little exhausting. Just kind of hearing a bunch of different messages. But now I think we've settled into, at least I've settled into somewhat of a routine. We're kind of after, April 1st, we know which tenants have paid, which fortunately enough, like a significant amount of tenants paid kind of portfolio. So that's really good. I think the next question is going to be May 1st, June 1st, and let's see how that rolls out.
Yep.
Health-wise, great. Family's great. It seems like I'm working more. There's the kind of business as usual part, and then there's like this added layer of, okay, now how are we going to cope with the future? As well as, I think, such as we're doing this call, it's trying to stay on top of, what opinions are out there from other leaders and influencers, and trying to get as much information as possible to then kind of, form your own, what's fact, what's fiction.
Yeah.
So there's just like this extra layer of just stuff that's going on in addition to just regular business. So I think there's more work. There's more work. There's more.
No, it's a good point. And same here too. We were having a conversation with the team, and it seems like, we were doing business during the day, and then Kelly and I are on these like Zoom calls at night. We've got the Right Club, Rain, all these different, we're hearing about mortgage changes, it's different because you're trying to stay on top of your business and project the future. And I think that's what a good real estate investor does is we don't have necessarily the answers. We don't know when things are going to change or shift or whatever. However, what can we put into our arsenal right now to defend ourselves when that time does come?
Yeah, no, absolutely. Yeah, no, for sure. I think, as a business owner, and it's such as yourselves, like it's the, you're in a leadership position, so you have to stay on top of things, and you're crafting, you're crafting strategy on the fly almost, right? Which is the kind of antithesis of strategy, right? Like it's you're almost kind of changing and adjusting, or at least your perspective. So I mean, in the long term,
the plane as you're flying it, as they say, right?
Yeah. So, but in interesting times. I think coming out of this, everyone, we should have new skills. We should have new ways of, coping and working, etc. So it'll be interesting to see, as we, this will pass.
So on that, what's your opinion right now with COVID-19? Do you feel it's a good time to buy in terms of your future acquisitions? Where are you standing with all that right now?
Yeah, it's a good question. So I operate two strategies, right? So a short term and a long term. Long term is the multifamily, the apartment buildings, which we'll get into. The short term. So I started investing in 2015, mid 2015. It was flipped. So very short term type of strategies, and then kind of got into holding. So had a number of duplexes, a fourplex as well. And then a number of years ago, probably 2.5 years ago, moved into apartment buildings. So in the short-term side of things, fortunately, the projects that I do have on the go were started before April 4th. So those are continuing. Big question marks, I think, like everyone has, about what are these things going to sell for? Because we're timed to go on market in the middle of all of this, right? So from the short-term perspective, a lot of question marks. I think in terms of the projects and management, I mean, the margins are good enough that it's going to weather some of the declines. I expect some declines, but we'll see. So in terms of buying short-term stuff, paused right now, unless a crazy deal comes across my desk. I have walked away from some short-term deals because they just weren't good enough. They were great kind of pre-COVID, but it's just too much uncertainty. I kind of want to sleep at night.
We're in the same boat, to be honest. We do a ton of flips as well. And in this market, you don't want to get caught with trying to catch a falling knife. And
Yeah.
the way to
Yeah.
think of it is trying to chase the market. We can say that in the real estate agency side all the time, is that,
Yeah.
you list here, but you should be here. And by the time you come down to here, it's now here, and you don't want to be chasing it. And unfortunately, flips fall into that category. So we're going through one actually right now in Hamilton too, which is going to be listing hopefully in the first week of May. But
Yeah.
it's the prime season for the big I don't know, right?
Yeah. 100%.
So jumping onto the topic quickly on like veering back towards multifamily.
Yeah. Yeah.
Why, like what started, like I love the fact that you have two strategies, and I think it's brilliant in my opinion. I think a lot of investors do that and should if they don't. But why multifamily as your vehicle?
So I'll tie into kind of what's going on with multifamily right now, and actually, it's actually a point as to why I'm in it in the first place. So I needed a little bit more stability in the portfolio. I like the scalability component. So instead of buying 5 duplexes by one building or whatever, depending on the size. The other part of it is I feel like you have more control with regards to the valuation of the value of the asset. My background is, as I think you mentioned in the beginning, business. So ran a consulting firm for a number of years, just kind of in the middle of exiting, which is kind of been a long kind of part of my life. But there was about building a business and how do you help other clients maximize ROI and turn things around. And so I see buildings as similar to that in terms of at least our strategy, which is buying assets that are undermanaged for whatever reason. There's a whole bunch of different reasons: improper management, the owner didn't know what they're doing, or perhaps tired owners, but it's underperforming. And so grabbing that, turning it around, and now I'm able to higher valuation. What I really liked about it is it wasn't really dependent upon the building next door or across the street. The valuation is really dependent upon what the operator can do, right? From a net operating income standpoint, increase your gross revenues, decrease your expenses, voila, you have a value, right? Pretty cut and dry. So the business aspect of it is really what kind of caught my attention. In terms of your question, what's going on with it now? Are you buying? You're not. So we have a 12-unit building under contract. There's a few others that we're looking at very closely right now. Again, this is a long-term game. So in 5 years, 7 years from now, 10 years from now, I think we look back, this COVID will be, a blip on that radar. The value in 5 years, COVID or no COVID, I think is going to be the same 10 years from now, definitely. And so I'm not worried about getting into a multifamily apartment building right now. In fact, we're in the middle of a due diligence process. We haven't pulled back. We're moving forward. The closing will probably, the closing we may push back a little bit. The closing is scheduled for end of May, early June, kind of, so we'll be right in the middle. So again, not worried about it. Now we'll have to see at time of closing or close to closing, our tenants continue to pay, et cetera. So there's, some things we'll have to look at. But from a long-term strategy, it's we like to think about it as the safest asset class in real estate, relative to other commercial, asset classes such as office, which is getting killed right now, retail or industrial. Industrial is doing well, but it is volatile depending on the time. But you look at apartment buildings, it's the recession-proof asset class, right? When times are good, it does well. When times aren't so good, it does well. Now we're in a different place. This is a health issue, a health pandemic versus a financial crisis. But I think the longevity of the asset class helps me sleep at night, at least.
Totally. Yeah. I mean, you can't really beat the bricks and mortar at the end of the day too, right?
Yeah.
I think that we just actually bought our first apartment building ourselves, an 8-unit, and
cool. Congrats.
It's a really crazy process, but a lot of things kind of resonated with what you just said in terms of I look at it in 5, 10, 15, 20 years. This is legacy for us, right? So
Mm-hmm.
my partner and I are looking to eventually pass this on to our kids and hopefully
Yeah.
grandkids. So
Yeah.
if you could do me a favor, and because it's super exciting, you said you had a 12-unit building?
So we have 14. So between my partner and I, we have 3 buildings. So we have a 14, 12, and we're working on a 12 right now.
Well,
So we have under contract and we're doing our due diligence right now.
so
And
can you walk me through that whole process of like how you found that property? What
mhm.
are some of the things that you're looking for? Just like a high level as
Yeah,
to walk us through your thought process towards acquiring this and saying, you know what, this is going to be a good purchase.
yeah, sure. So just by way of background and context, so there's a number of different strategies, just as in the single kind of family space, there's multiple strategies. In apartment buildings, same idea applies. 2 basic ones, I guess, to differentiate kind of the value-added approach, which is, you're acquiring something that's undermanaged, adding your value to it, which is, essentially increasing net operating income, and then, running it, versus a turnkey, which is, buying something that's already been optimized to a certain degree, and so you buy it, you don't really have to do anything, right? And that's both are great strategies. And again, it goes back to your why, right? So, depending on what your why is and how much time you have, et cetera, one of those will suit your needs. Our strategy is added value. And so the criteria that we look at, or things that we look at, has to be undermanaged, right? So it has to be underperforming. And typically underperformance means it's net operating income, or it's net operating income is lower than what it probably should be. And a lot of it, the first thing we look at is rents. Our rents, our criteria, anywhere from 30 to 50% below what it should be, right? So that already is, okay, a good indicator, because it means that once we take it over with some investment, with some CapEx, some capital expenditures, can we move it up, from a valuation standpoint? So that's our first thing. Right now, we're looking at kind of the 12 to 20 unit range. Nothing smaller than that. Larger, perhaps, if it crosses our desk, but right now we're kind of really in the 12 to 20 range. And from a market standpoint, markets that are just have good fundamentals, right? Large enough population that there's a good rental demand. There's investment from the province from a business standpoint. There's public and private sector investment, good transit, good jobs, employment, population growth, et cetera. So kind of some good economic fundamentals. And so those are the main things that we look at. And then from there, how we source them, as very different than single family. And so while there are apartment buildings on the MLS, most of the deals that we're reviewing right now are off the MLS, are off market, and basically, transacted or passed along through, the apartment building broker network. And so that's where we're sourcing the majority of our deals. And so they typically don't get onto the MLS. Not to say that we haven't. So, our Hamilton property was on the MLS. The Barrie one was not on the MLS at COVID, and our prior one was not on the MLS as well. So it's networking, and Mike, so my partner, takes care of a lot of the acquisitions, and he kind of spends his time really networking with brokers that funnel us deals at the end of the day.
No, that's way.
Yeah.
So when you see this property, is there a kind of a criteria from a price standpoint, like price per door, that you're really looking at, or how do you really assess from just a very high level? Because if you consider all the apartment buildings, right, and if 20 of them came by your desk, you have to have a quick process to kind of go through and say, okay, these hit these are my top 3 picks, and why would that be?
Sure. Okay. Yeah. Price per door might be the quick kind of not even back of the napkin, just a quick look. If someone sends an email, I guess there's 2 things. One, price per door matters when there's a actual price tag to it. So, a lot of times, we'll have buildings across our desk that don't have a price, but just the financial metrics. And then it's up to us really to determine what we're willing to pay based on capitalization rates. So in Hamilton, now it changes depending whether you're downtown or different, on the mountain, et cetera. So anything right now that's a kind of a 140 to maybe let's say 135 to 180 a door, we'll be like, oh, okay, let's look into that a little bit more. It may be overpriced, and maybe we don't, not sure, but at least that's kind of in the range. Like one just was sent to me from a seller a few days ago, and 175 a door, and where it's located, probably a good deal, right? So at the surface level, could be decent. Now let's look at what their income is, their expenses. So now we'll kind of dig a little bit deeper. If he came back to me and said, I want 200 a door, probably wouldn't even go to the next, conversation.
Yeah.
But it kind of fell within, it still may be a little overpriced, but hey, maybe they're generating enough income to support it.
Yeah.
In Barrie, that project is 200, just a little over 200 a door, right? So again, different market. If we saw 200 a door in Hamilton, it would have to be downtown Hamilton, kind of in the core, or very hot spot on the mountain. So again, it depends on the market. So I guess to answer your question, 130 to 200 a door, depending on the neighborhood.
Yeah, no, that's perfect. So I really liked how you put that. There was one specific point there that really stood out for me, is that you guys aren't going and like talking to people and saying, oh, here's a building that's going to be $2.5 million. What you're saying is, okay, share some information about this building with me, and then we're going to present an offer based on our calculations. And I think that's a very proactive approach, especially when we're dealing, like, to all the listeners here, when you're in real estate investing, you're a hunter. You got to go and you have to hunt the deals, and that incorporates networking, that incorporates negotiations, and all those kind of points. You guys aren't waiting for the deals to necessarily fall in your lap. You're actually pursuing opportunities, and you're making those opportunities happen. And that's the difference between working hard and creating success and people thinking you're just lucky.
Yes.
And it's so funny when people think that, and you articulated it perfectly. And I'm glad you did, because a lot of people are like, even for us, like, oh, you guys are just so lucky. I don't know how you do it. It's like, well, you don't see what's behind the curtain, So on that note, let's say, I'm a seller, or we don't even have to role play it necessarily, but if you go and you request the financials from somebody, how do you sift through, and how do you know if those financials are legitimate? Or how do you know because an owner could beef up numbers to make it look like it's different. Obviously, rent rolls and stuff, they can't lie about it. But sometimes people strategically leave key elements out of a deal to make it a little sweeter. And I'm sure you've crossed that time and again, right?
Yeah, I think I wouldn't say every deal, but so the first thing I think is as an investor, you're an investigator, right? So it's almost like you're an investigator first, and your job is to sift through clues, information, and figure out, I wouldn't assume everything is wrong, but it's your responsibility to make sure that it's right. So, for example, a deal that we reviewed a couple of weeks ago, I forget which market, it might have been Hamilton. Was it Hamilton? Yeah, it might have been Hamilton. Right away, was it Hamilton? No, it was actually this Barrie building. It was actually this Barrie building, and I think it was one of the utilities. I believe it was water. Water was showing like $600, for the year. And that doesn't make sense, right? And so based on the current properties that we have, as well as just reviewing deals all the time, you kind of start to get benchmarks in your head, right? In terms of cost per unit per year, right? In terms of what the line items should be. And if you're getting something different, then it might not, it's not that it's wrong. There could be an opportunity for improvement, right? So for example, maybe their water bills are way too high. Maybe there's, leaky toilets, or there's leaks, and so they're just paying way too much. Well, that's good for you, because that's an opportunity to improve net operating income, to reduce costs. So I think partly based on, so we'll compare to the properties that we have today, as well as, again, looking at so many deals, you start to create or internalize your own benchmarks as to what makes sense and what doesn't make sense. And at the end of the day, it's you're the investigator. The other thing that happens a ton, and So we help out people getting started as well, not in a formal consulting program type of way, because we've decided not to really focus our attention on that, but we'll help, people that we know and that are looking to get started, etc. So I reviewed a deal for someone, this week actually in Windsor. And again, I'm not familiar with the Windsor market, right? And so you should be familiar with the market that you're going into, or work with someone that knows the market, just because you need to understand market rents and capitalization rates and a whole bunch of other things for that market specifically. But they sent me the financials, and you see this all the time. There's a net operating income, which was, let's say, $35,000 or $40,000. It was a small building. I think it was like a six unit. And so the net operating looked good on paper, but there wasn't property management, there wasn't repairs and maintenance, and some of the things that a lender will automatically put in as an expense when they figure out what the valuation of the building is, or an appraiser might do that. And so, the owner, it might not be an owner cost because they might be doing it themselves, but as an investor, you have to look at the valuation. We say in two ways. One, you have to have the lender view. So how is the lender going to evaluate it? And we've been fortunate that we've picked up deals where the financing has fallen through for this reason, because people just didn't underwrite it properly. So view number one is how is it going to be evaluated or valued, underwritten by the lender, and then how are you valuing it? So what is your cash flow? Because you may manage it yourself. You may have your own, means of doing repairs and maintenance that's a little more efficient than how the banks may evaluate it, and so you may actually be better off, based on, in comparison to how a lender will do it. So, long answer to your question. There's a few ways to do it, but I think that the main thing is you'll typically get financials from a seller. And again, it depends on who the seller is. I think the more experienced the seller is, they're just going to give you the financials, the appropriate ones, because they don't want tire kickers either, right? They just want to get it. They want to sell it for a reason, right? They're not looking to drag this thing on, right? They know what the value is. They also know that an experienced buyer is going to value this thing properly as well. So
on that note, actually, if you are relying on cap rates, which we all know in multifamily investing, we have to do cap rates as a high function for our calculation as to what the value is going to be. How do you determine from one city to the other? If you were in Barrie and you're like, okay, well, I'm a new investor here, I want to determine what the cap rate is, and then you move to Hamilton, how would you determine what the cap rate is in these different cities?
Sure. So I guess a few different ways. So Barrie, it's the first time that for in commercial that I've looked at or bought something in Barrie. So so I'm familiar with the market, its fundamentals, but not familiar as to, or wasn't at least now before this. But now, in terms of how buildings get transacted from a cap rate standpoint. So I look at a few different sources. Number one, your own network. So within your network, there may be people that transact or have properties in that market, to talk to them, fellow investors. So I think the event in the group that you host, places like that, perfect. Meetups, networking events. Someone has a property in the market that you're going, and if they don't, then go to that market, because there's probably a meetup there, right? Yep. So that's kind of first and foremost. I use the commercial appraiser I use. So I speak to him. And so because they have been in the business for a long time and they do buildings across Ontario, even other provinces, I'll ask them, have you appraised buildings kind of in the last 6 to 12 months? And so he'll send me what the cap rates were for their appraisal, as well as then the lender. So I'll also talk to the lender. Right. And so then they'll have, we've done, deals in this market, et cetera. And they'll give you a range. So it's never an exact amount, it's always a range. And so you kind of want to use that range to help, figure out your underwriting.
No, that's excellent. So for those of you guys who are wondering, like, what do I do and how do I find a cap rate? Because that's a key element in determining your value for sure. Right? So yeah,
absolutely.
I would like to touch up on something in terms of finding these undervalued properties and how you're dealing with tenant turnover and renovating buildings and things like that? And what's the strategy behind it? What do you feel is
Mhm.
critical about it?
Yeah. So good question. So like I said, I think one of the criteria, so this kind of finding the underperformer, it has to have average rents about 30 to 50% under market. And that's 30 to 50%. So when I say market means once the unit has been renovated, what's the max kind of rent that I should be able to get with a renovated unit, giving, it's the mix, the size, etc. So a comparable unit. So in terms of tenant turnover, I think, and I see this a lot, and I think it's a mistake that I see, and it might be just a function of the underwriting philosophy. So our underwriting philosophy is to underwrite conservatively, and typically you're going to get a little bit more than what your conservative estimates are. And what I mean by that is, I've seen it a lot where there's an assumption that you're going to turn over 100% of your tenants in a short amount of time, or even throughout the duration of your project. I think that's a risky proposition. And so first and foremost, we don't assume 100% turnover when we project our ROI. 25% year one, 25% year two, 25% year three, depending on the building. So that's kind of part one of that. The other thing when evaluating buildings, you have to look at the tenant profile, right? So if let's take a 10-unit building, and let's say 8 of those 10 units have long-term tenants, so have been there, let's say 10 years plus. Mm-hmm. Now, your job as in a value add kind of strategy is to turn those units over, meaning, get the tenants out, help them. I mean, we help the tenants leave in the projects that we're doing now. We actually have someone that's been hired specifically to find the tenants that want to move a new place. So it actually makes it a little bit easier. But if someone's been there 10 years, the probability that they're going to want to move is quite low. So you have to factor that in, mm-hmm. right? So in your underwriting, you have to look at how long have they been there? What's their demographic profile? What's the cohort? So millennials are more likely to turn over a little bit quicker. Perhaps growing families. So you have to kind of look at the cohort and look at the probability that they're going to move or not move, and factor that into your consideration. So now you've acquired it, right? So what we've done is at first, in the first month, is have conversations with the tenants. What are your plans? It's an introduction to the new management. What are your plans? We're going to be renovating. Typically, anywhere from 15 to 20% of tenants will reveal that, oh yeah, I've been thinking of leaving, or, one tenant, a number of months ago, yeah, my family wants me to move to a nicer building, etc. So great. You know what? We will help you do that. We'll help with moving. We will actually have someone on staff that will find, others, give us your criteria, and we'll do a search for you. So that's been helping out. So that's kind of step one. If it's a tenant profile that's, late on rents, etc. So we'll, our N4s, N5s if needed. So be very consistent with our N forms.
That's good.
And then, cash for keys. Although we haven't really, we've done that a couple of times, but we haven't really had to rely upon that method too much, because we have this progressive kind of way of doing it and just having conversations with people. So, but I think you have to really be conservative on the number of people you're going to end up turning over, because you could really overestimate that.
Yeah, it's a wise piece of advice. If I could share a little story about the one we just bought, mm-hmm. One of the tenants called the city on what she thought was the previous owner, because we hadn't taken possession yet. Yeah. So by the time the city came to the property, we had then taken ownership. It was literally within the week. And he was complaining that there were structural issues on the property. So he posted a notice on the front door. By the time they got a hold of us to let us know, because we're still, getting our things together, half or 3/4 of the building had already gone, oh my God, I got to get out of here.
Really?
Get an engineer in. So within a month and a half, or just under 2 months, we've gone down to 2 tenants from 8.
Really?
Yeah.
Really?
So one of the tenants is just someone who hasn't paid since God knows forever.
Yeah.
Even the previous tenants. So they had a hearing booked, but the LTB is now on hold. So
Yeah.
on hold, and the other people they're actually totally cooperative. They're just finding a place that's going to be suitable for them before they move.
Really?
We've offered to pay for their moving costs and stuff, so we're being
Yeah.
accommodating.
Yeah.
But I think we got lucky, really.
That's really good.
Yeah,
That's
so
really good.
tell people like, oh, actually, I don't know how it happened, but it was just luck. But on that note, with the LTB and the delays that we've kind of been seeing right now, what are your thoughts with that whole process, and especially in multifamily when we're dealing with a higher volume of clientele, which effectively is our tenants?
Yeah.
Dealing with those delinquencies is becoming incredibly more like difficult, right? So how do
Yeah.
you deal with that?
I mean, yeah. I mean, it was difficult before COVID, right? Just the length of time, right? Like, I mean, get your papers right. I mean, we use a paralegal now. I used to do it on my own, made a lot of mistakes, a lot of setbacks, like a lot of delays, right? If you don't have the right paperwork, if you don't have the right, really literally properly dot your I's, cross your T's, it's going to set you back months. And so we don't do that anymore. We use a paralegal to do all that stuff for us. So in fact, it's even more of a reason now to, I think at this time, and we spoke about it in a webinar that we did a few weeks ago, or actually Facebook Live. If you don't have good relations with your tenants or didn't really kind of engage with them, now's really the time to do that, because you don't want to go to the LTBs. You don't want to go to the LTB, before this. Now it's going to take you 8 months to get anything sorted out, right? So if you can negotiate, if you can come to a settlement or an agreement without going to the LTB, I think that's going to be in your best interest for both parties. I mean, that's always the case anyways, but I think now more so than ever, if you go to the LTB, I think you're at a disadvantage because it's going to just take such a long time. So the more you can keep out of the LTB right now, I think the better, at least for the next 12 months.
Very, very wise words, for sure. For sure. I do think that this pendulum has swung pretty far to one side, that they're going to have to make some sort of changes.
Yeah, absolutely. Yeah.
It's actually crazy.
I think this will shine a light now on just how inefficient the process is. And so, hopefully I know there's, a number of landlord groups speaking up, which is great, which we're probably, both a part of. And I think, and not that they weren't advocating before, but now their advocacy, I think, given the delays and, given the spotlight that the tenant landlord relations have had over the last month or so, through the media, through politicians, et cetera. So, hopefully, I don't know if it can get worse, maybe it can, who knows? So hopefully it does get better.
Yeah, I hope so too. Just kind of wrapping up slowly, I was hoping you could maybe share a quick example with us of a property, like the high level numbers of, what you bought for initially, what were some of the key factors you saw that you could improve on, and what was the final result, just to kind of share that a win scenario for us.
Yeah, sure. So, talk about, property we have in Hamilton, 14 units. It's, so the rents, average rents, I think when we bought it, maybe $750 or so.
These all one bedrooms?
12 ones, 2 twos.
Okay.
And so, some people were still paying, a lot of them are gone now. We're paying 600, 650, right? Market rent should be 1450, 1450. With kind of it's about a 550 square foot units. They're all the same. Mostly, in fact, that was kind of one of the reasons why I bought it, because they're all very consistent. And so the lift on those units, from let's say a 750 to a 1450, or even to a 1400. With that $700 lift or $650 lift, the valuation, the value increase on, and the renovations that we're doing about $30,000, $30,000 to $35,000, depending on the size. And we're
Per unit.
Per unit, yeah, per unit. Completely gutting it, quartz countertops, brand new, kitchen, stainless steel appliances, wall-mounted AC units with as well as a secondary heat source, in-suite laundry. So, self-contained units. The value increase in spending the $30,000 per unit, or increase the value of the building by about $170,000, $170,000 per unit.
Wow.
And so the total ROI of the building originally projected when we bought it was about 30%, 32%. We're probably doing about 43 to 44% ROI annual per year on that building. We're about to come up to a refinance right now. So we'll see how this, everything plays out. But that's been again, that was very conservative underwriting. We've surpassed that. Our investors are very happy with what's kind of going on there. And that's, we're just duplicating that model now. So with other properties, yeah.
On that first initial refinance, were you able to pull out a surplus from what you had spent, or was there a pretty significant amount of money still left in the deal?
So we're about to do that right now. So in that specific project, we're about to do the refi right now. We will, conservatively speaking, we'll pull out the majority of our money and investor money.
Good for you, man. That's awesome.
Yeah.
Imagine owning a 14-unit building and having next to no money in it.
Yeah, that's the plan.
You guys are also the real estate professionals, so you guys are advocating and working and bring investors in to invest with you. So
yes.
From your guys' standpoint, it's the sweat equity that you bring to the table. So
yeah. I mean, the model that we run, hands-free. So, people that are looking to build generational wealth through and these times right now, I think will prove this out even more. Apartment buildings, kind of a very safe and stable asset class compared to everything else that's out there. And so if you're looking long-term and building generational wealth, we work with people that want to do that. And we take care of it all.
I love it. It's fantastic. So just in kind of a closing statement here, do you have any advice for people who have really thought about investing in multifamily? I know multifamily can seem overwhelming. I know I talked about the building we just bought, but even that was like, oh my Lord, but we've done so many other deals, and it's like clockwork. Now we don't even hesitate. We just, we'll put an offer on this. But multifamily seems like this step up, and it is. So you're kind of adding a zero to the end.
Sure.
What advice would you give to some young investors who are looking to get into this game, obviously with what kind of a wonderful asset class that it really is?
Yeah, I think, and this is the reason why, Mike and I started the podcast actually in the first place, is because we think and believe this very strongly, that anyone can get into it, whether you've done real estate before or even if this is your first kind of asset class. Now, if you've done other real estate strategies, you'll benefit from that because, you're used to the motions. It's just, add a zero to it, like you said. But it's all psychological, right? So, anyone can do it. It's all just a mindset piece. And so, believing that you can do it is one thing. And then once you believe that, then it's, educating yourself, surrounding yourself with people that have done it, or partnering with people that have done it to take you through that. So we all, especially now, I think now it's more evident than before with digital means, digital education, people doing and talking about it. My advice would be to educate yourself first, right? I mean, these are the steps that I went through. So before getting into it, 2.5, 3 years ago, I educated myself on the asset class for 2 years. Listened to podcasts, a lot of podcasts out of the U.S. There weren't really any Canadian podcasts about apartment buildings. That's why we started the one that we did.
Thanks for bringing it up.
And great stuff. I mean, I went to conferences in the U.S., right? And because there was really nothing here with about apartment buildings. So I think podcasts, there's books. There's, tons of videos. And so just to familiarize with that. And then I would say start analyzing deals, right? Just analyze deals. I think you have to get familiar with the metrics, the key performance indicators, how to use a cap rate, right? Like, what does a cap rate mean? Just kind of just exercising the analytical, mind, right? And then I would say, for your first one, get a coach or partner with someone that's doing it. Right? Because, so while it's not, it's probably the least risky, real estate asset class. If you do make a mistake, they're bigger mistakes, right? Because it just costs more, right? So I think once you have it, it's a stable asset class. But getting into it, mistakes are very costly, much more costly than single family. So a coach, partner with somebody, et cetera, I think to kind of guide you along the way. And then I think once you do one, you're well on your way.
I love it. I love it. Well, listen,
Mm-hmm.
this is fantastic. We're actually going to be posting your Instagram handle as well as your Facebook handle,
Cool.
okay, on the post here. So, guys, check out Mark on his podcast. So, the Canadian Multifamily Investing Podcast is a wealth of information. Keep your eyes out for his book that's going to be coming out. Not sure when, but I'm excited
couple
for it.
months.
I'm going to pick up a copy for myself. So
Cool.
Just want to say a big thank you for taking a little bit of time out of your day here. I know how busy things are with COVID. I'm glad you guys are safe with your family, and thanks for providing value, because at the end of the day, that's what it's all about, right?
Yeah, no, thank you. I mean, for having me on. I mean, you've done some great stuff, and the platform you've created. Again, you're adding tons of value to people, right? So it's again, appreciate it. Really excited to do this, and thanks for having me.
Hey, our pleasure. Thanks, guys. So stay tuned, everybody, for our next GHAIN event. We'll post it out, and stay tuned. If hopefully you guys pick something out and can change the trajectory of your lives. Cheers.